Let's solve question number 5 from our May 2024 examination. This question is on Accounting Standard 21, Consolidated Financial Statements. Shall we begin? The balance sheet of Art Limited and Craft Limited as on 31st of March 2024 is as follows. Don't waste time on reading the balance sheet, quickly come to adjustments. What have we been given after? Art Limited acquired 3,200 ordinary shares of Craft Limited. Very good. And they've given reserves and surplus as well as profit and loss account on the date of acquisition. They have not given on the date of acquisition. Remember, the acquisition happened on 1st of October, but they've given it as on 1st of April. Whatever is there on 1st of April is obviously pre. After that, whatever is there is current year profits. That will be split based on that time as to how much is pre and how much is post. Then there is some adjustment with regard to plant and machinery. There is some revaluation. Let's do a smart thing. Let's come here and then mark our plant and machinery. Plant and machinery of subsidiary has to be revalued on the date of acquisition. Then depreciation adjustment is also there on that. So plant and machinery and depreciation on that. We'll adjust the same. Then Craft Limited deducts 1% of trade receivables as general deduction. Craft is who? Craft is subsidiary. Craft, the subsidiary, trade receivables. Where is the trade receivables? Straight away in the balance sheet only. So this Craft Limited's 168,300. That is after deducting 1% provision. But what is the logic here? They are not going to do that provision. This policy is not followed by Art Limited. To bring in uniformity in accounting policies, that 1% which is deducted and the trade receivables which are shown at 99% should be now shown at 100%. That 1% had previously reduced the profits. Now we'll add it back to profits. Reserve analysis will get impacted by this. They told inventory includes goods which it had purchased from Art. Craft Limited, which is a subsidiary, notes to accounts is not there. Here, its inventory of 2,05,000 includes inventory which has come from holding company. So it is downward. Holding company has sold goods to subsidiary. We'll eliminate it from the inventory of subsidiary. We'll eliminate it from the reserves and surplus of the holding. Reserves and surplus is there here. Here I'll mark P&L a little highlight, stating that this has to be adjusted. Reserves of the holding company, which is relating to its profit and loss, has to be written in inner column because we need to eliminate unrealized profit from the same. Understood? What do we have after that? After that, we have yeah, that's it. 1,03,500 on which 15% at cost price. Cost is 100, profit is 15, selling price is 115. Selling price is 103,500. We should do cross multiplication 15 by 115 to find the profit. We will do it eventually. Got that? Now let's start from the balance sheet. To begin with, I will take a different color. Shall I take a green color to mark the items which have been posted? Equity share capital, shareholders fund, share capital. I'll start with holding company share capital. I'll go to notes to accounts. Notes to accounts is 6,50,000. Am I right? 6,50,000. It is comprising of only one class of shares. 6,500 shares of rupees 100 each, which is coming to 6,50,000. This will be as it is posted to my balance sheet. Yeah, I will write here 6,50,000 in the consolidated balance sheet. Then we have subsidiary share capital, which is 4,000 shares of rupees 100 each, 4 lakh. This will not be taken straight away to balance sheet, consolidated. This has to be split between holding and minority. So I will bring you to my notes to accounts, wherein I will write share capital of Craft Limited, who is my subsidiary, which is 4,000 shares of rupees 10 each, coming to 4 lakh. How many shares of this is held by the holding company? We don't know it right now. Do we know it? No. We'll get to know later. So this 4 lakh is done. Then come back to reserves and surplus. Reserves and surplus of the holding company, I should go to notes to accounts. Let me go to notes to accounts. We have reserves and surplus in the next page. General reserve of the holding company 1,20,000. No adjustment whatsoever will be posted to reserves and surplus in consolidated balance sheet. However, I will prepare notes to accounts. For reserves and surplus, I will write here note number 1. And in my note number 1, I will write reserves and surplus, general reserve, total 1,20,000, no adjustments whatsoever in outer column. However, when I start with P&L account of holding company 1,92,000, this goes to inner column. Why? It's been already marked yellow, meaning there is adjustment. Unrealized profits has to be adjusted against it. So in my consolidated balance sheets, notes to accounts, under reserves and surplus, I'll write P&L 1,92,000 inner column. We're done with holding company's part. Now let's have a look at subsidiaries part. Subsidiaries 40,000 and 2,08,000 has to be analyzed. First, it should be split as pre and post. Then it should be split between holding minority and then there is adjustment. So shall we do that? I'll take it to not my notes to accounts but to a table after that. I'll write reserves of subsidiary. General reserve 40,000, P&L account 2,08,000. This has to be analyzed into pre-post, then holding minority. We'll do it eventually later when we have sufficient information. Right now, I'll move on. I'll come back to balance sheet. After reserves and surplus being taken care of, we have trade payables. Trade payables, they have not given any notes to accounts. They've straight away given amounts. I have not even marked it with yellow, which means there is no mutual indebtedness adjustment. So I'll straight away take 145 plus 92 in my consolidated balance sheet. There's no need to do notes to accounts also. Shall I write it here? This is trade payables 145 plus 92. If you would find it more comfortable, I don't mind. I can open trade payables notes to accounts. Art Limited 1,45, Craft Limited 92, 2,37. Or you can choose to skip this and write 2,37 straight here. Either ways is fine. But there is no mutual indebtedness. We glanced through the question once, we did not find any. Am I right? What do we have after this? Next we have short-term borrowings. How much is our short-term borrowings? 70. This is of holding company. Note number 3. Have a look at note number 3. There is nothing. There is only bank overdraft of 70. And in the process of consolidation, we are not making any payment. So what would I do? I straight away write short-term borrowings. Note number 3, 70. Because I have written note number 3, I will open one note and dump the amounts here. But in fact, not required. They are only next to short-term borrowings. If you want, you can write bank overdraft and write 70. No marks will be cut for that. If you want to play safe, if you have enough time, do open one notes to account. Here also hardly 2 lines. Am I right? Come to the next item. Next item in the balance sheet after short-term borrowings is that's it. We are at the end of balance sheet liability side. Let's move to asset side now. We have PPE, property, plant and equipment in non-current assets. This is 4,21,000 of holding company, but they've given note number 4. I would want to go to note number 4. I won't straight away add them. Come to note number 4. There is an item with adjustment, plant and machinery. So my land and building 1,90,000, their land and building 1,35,000 has no adjustment. I will add 190 and 235 and write it as 345. Shall I do that? Observe property, plant and equipment, land and building, art 190, craft 135, no problem. Then we have another asset called plant and machinery. That of art has no problem, 231. That of craft has to be revalued. So I would write art limited's 231 outer column, craft limited's what is the value? 2,25,000. I'll write 2,25,000 in the inner column. Now we need to revalue this. See, 2,25,000 is at the end of the year. Revaluation will happen at the beginning of the year. So I'll first find the value at the beginning, do revaluation, and then not beginning, at the date of acquisition. We're at the end of their consolidation date when it is 2,25,000. I'll take and identify the value as on date of acquisition. Do revaluation, then do depreciation, and then write. I need to go back in time and I need to come front in time. We'll do it eventually. Right now I'll write 2,25,000 in inner column. Next, by this we're done with property, plant and equipment. The moment you finish one notes to accounts, don't go to another notes to accounts. Go to balance sheet. From balance sheet only you should come to notes to accounts. Then we have non-current investments, which is note number 5. How much is that? What is the value there in non-current investments? 4,32. This might represent investment in subsidiary. This might not be only investment in subsidiary. There can be something else also. See what is there in note number 5. We've done questions in the past where the investment was not only in subsidiary. There were some other investments also, which we continue to show in balance sheet. So 4,32 is the investment. This will go to our cost of control. You remember cost of control as book value of investment. How much is book value of investment? 4,32. This stays in inner column. Why? This has to be adjusted for pre-acquisition reserves. Understood? 4,32. This represents asset or liability? Asset. Am I right? Then come back to balance sheet again. What do we have after non-current investments? Inventories. Our inventory is 1,66,000, no problem. Subsidiaries inventory of 2,05,000, there is unrealized profit which has to be eliminated. So I'll open one notes to accounts for inventories. I will write Art Limited's inventory 166 outer column, Craft Limited's inventory of 2,05,000 in inner column. Later I will deduct unrealized profit from this and then post it to outer column. Okay. What do we have next? After inventory, trade receivables. There is notes to accounts. Don't take straight away 133,500 and 168,300. Go to notes to accounts. See what's happening in notes to accounts. Trade receivables. There is nothing here. They have not given only. They've just given number. That 6 is actually for cash and cash equivalent. So I'll take 133,500. My trade receivables, no problem. Subsidiaries, it's marked yellow, which means that it has mutual indebtedness. So I'll keep 168,300 in inner column, 133,500 in outer column. Shall I do that? Next note, trade receivables. Art Limited, 133,500 outer column, Craft Limited, 168,300 inner column. I hope you all understood this. Next, after this, I have cash and cash equivalent. No adjustment. Take 24,500 and 6,700. Write the total together. Because there will be no cash payments happening here in consolidation. 24,500, 6,700. In fact, the total is safe to be posted to balance sheet also. I am doing it instantly. You can choose not to. You can choose to write it in respective notes to accounts. Don't even total notes to accounts until and unless you finish all the adjustments. Once you finish all the adjustments, then you take the total and post it to balance sheet eventually. Got this? Very nice. After this, let's go to adjustments. Art Limited acquired 3,200 ordinary shares of Craft Limited. We had written here the share of holding of C Limited or Craft Limited. In this 4,000 shares of 100 is 4 lakh. I, Art Limited, own how much? 3,200 shares, which comes to 3,20,000, which is 80%. This 3,20,000 what I own is nominal value of investments. I'll take it to cost of control. I'll write nominal value of investment. How much is it? 3,20,000. There is no adjustment, bonus issue or anything. So it's obviously in outer column. And Craft Limited's minority will hold 800 shares, which is 80,000 rupees, which comes to 20%. This 80,000 will go to minority interest. So later at the end, when I prepare one table called minority interest, there I would write share capital 80,000. And 80%, 20%, I would write it here, which will later help me to share my reserves between holding and minority. Am I right? What is after this? Next, reserves and surplus of subsidiary. Reserves is 40,000. P&L is 58,750. But this is not on the date of acquisition. This is at the beginning of the year. Come on here. I would write in my general reserve pre-acquisition. That is as on 1st of April is 40. Reserves are not earned during the year. Reserves are made at the end of the year. So general reserve, there is no problem only. On the date of acquisition, it is how much? 40. Post acquisition is 0. Because reserves, general reserve will arise because of transfer from P&L at the end, not during the year. But that's not the case with P&L. P&L is 2,08,000. Before 1st of April 2023, it is 58,700. That's what is given in the question. This will be pre. Now I cannot say 2,08,000 minus 58,700 is current year profit. We cannot say it is post. It is current year profit. How much is 2,08,000 minus 58,700? That is the profit earned from 1st of April to 31st of March. This is not completely pre. The acquisition actually happened on 1st of October. Till 1st of October, whatever is there is pre. After 1st of October, October, November, December, January, February, March. 6 months of income is there, no? That becomes post. That is revenue, this is capital. You guys understand this? How many months is it till October? Can I do into 6 by 12? 1,49,300 into 6 by 12. 74,650. Post acquisition, it will be 74,650. But this is not the final answer. Why? There is one provision reversal adjustment. When the provision is created, profit would have reduced. Debtors has reduced. When the provision gets reversed, debtors will increase, profit will increase. That I will do for this 74,650, which is post. Sir, why post? Why not pre? Why not pre? Provision is done at the end of the year, my friend. Provision is not done during the year. Are you getting it? So then after deduction, you would share no pre and post. You need to understand in standalone profit and loss account of the subsidiary, there will be still provision. You're doing this because of acquisition by holding. So this is only for the post acquisition period that should be given impact, not for pre. I hope you understood. Any adjustments happening to the assets, it's not in the standalone. It is only for consolidated. That too because holding companies uniformity in accounting policies is not there. To make it uniform for consolidation, we're doing this. Everyone got this? Come back to the next adjustment. We are done with the first adjustment. Yay! 2, 3, 4. That's it. Second one. Plant and machinery of craft, which stood at 2,50,000 as on 1st of April. 1st of April is beginning. Was considered worth 2,20,000 on the date of acquisition. 2,50,000 is at the date of beginning of the year. 2,25,000 is its book value. Observe, the value of the asset on 1st of April 2023 is how much? 2,50,000. Now, when is the acquisition happening? 1st of October. Year ending is 31st March. If you depreciate this for full year, 10%, what do we get? You will get 25,000 depreciation. Value will become 2,35,000 or 25? 25, sorry. 2,25,000. Am I right? Yeah, observe, on 1/4/2023, the book value of the asset is like, this is like 100, this is like 10, this is like 90. Am I right? Here we take 2,50,000. The acquisition is happening on 1st of October. So revaluation is also happening on 1st of October. 1st of October is not the end of the year. Here we charge it full year depreciation to arrive at 31st March value. Here I should deduct depreciation for 6 months to arrive at 1st of October value. If you observe in the standalone balance sheet, the value of the asset is 2,25,000. This is 2,50,000 depreciated for full year. Now we should depreciate for 6 months, do revaluation and then do depreciation for 6 months. Are you getting it? What is the value for depreciation for 6 months? 10% into 6/12. What do we get? 12,500. Then I will get the book value on 1st of October 2023 to be how much? 2,37,500. Understood? So the value of the asset on the date of acquisition before revaluation is 2,37,500. On that, they would have charged a depreciation of 12,500, 6/12, and you would get 2,25,000. This is what is there in balance sheet. Am I right? We cannot do 237,500 into 10% into 6/12. 2,50,000 year beginning value into 10% into 6/12. Full year depreciation is 25. First half of the year 12,500, second half of the year 12,500. But they are telling this asset is considered to be worth 2,20,000. 2,20,000 meaning 2,37,500 value of the asset is changed to 2,20,000. It is changed to 2,00,000. So it is downward revaluation or upward revaluation? We are revaluing the asset downward. Previously we would have charged a depreciation on 237,500, but depreciation actually should be charged on 2,20,000. We have charged excess depreciation which should be reversed. That is on 17,500 if you apply 10%, what do we get? Or you take 11,000 minus 12,500, 1,500. We would have already charged a depreciation of 12,500 before revaluation. Because of revaluation on 2,20,000, if you charge depreciation at 10% for 6/12, it eventually comes to 11. So 1,500 rupees excess depreciation was charged, which is supposed to be now reversed. Understood? So the value of the asset that should go to balance sheet is 2,20,000 minus 11. Revalued in the middle of the year on the date of acquisition, 2,20,000. On that 6 months depreciation at 10%, 11,000, it comes to 2,09,000. Do you all agree with me that 2,09,000 is the value that should go to balance sheet? That is 2,20,000 revalued figure minus 11,000 depreciation. Have a look. I'll take you to notes to accounts. Notes to accounts. I will say it should be recorded at 2,20,000 minus 10% depreciation for 6 months. 2,09,000 is the value. And previously they have charged excess depreciation. Now we are reversing depreciation worth of 1,500. So now my profit has to be changed. Previous year's profit, that is post acquisition. Revaluation is always pre. You know that, no? In fact, we forgot that. Revaluation reserve. Really? Revaluation reserve. If it is upward, I would have written positive. It is downward. Downward by how much? 17,500. I'll write it as minus 17,500. Completely pre. There is nothing post about it. But depreciation on this is post. How much is depreciation to be added back? 1,500. Come to my P&L here. I would add back 1,500. Did you all understand why am I adding back 1,500? Say something. There is another provision adjustment also eventually. So by this we are actually done with asset adjustment. Yeah. If you did not understand, slowly redo this topic and you will be finding this comfortable. Not very difficult. Then also you can revise the concept of revaluation of assets in consolidation. That will also throw more light on this. Then depreciation 10%. This is also done. One second, let me make it all green. This is done here. Now come to third adjustment, last but one. Craft Limited deducts 1% on trade receivables, which is not done by art. Let's reverse it. Come to trade receivables. Where is our trade receivables? Trade receivables. 168,300 is there? No. That is after deducting provision. Now I am going to add back provision. How much do you think is provision? See, 100 rupees is debtors. 1 rupee provision. After deducting 1, you get 99. 168,300 is 99. How much is 1? Divide 168,300 by 99 and multiply that by 1. 1700. 1700 was already deducted. That is the reason we got 168,300. Now we don't have to deduct it. Provision need not be maintained because holding company doesn't do it. Add back. What do we get? 1,70,000. When we created provision, profit would have decreased. Now we don't need provision. Profit will increase. Which profit? Post profit. Why? Consolidation ಆದ್ಮೇಲೆ reversal ಮಾಡ್ತಾ ಇರೋದು. Are you getting it? Sorry, acquisition ಆದ್ಮೇಲೆ reversal ಮಾಡ್ತಾ ಇರೋದು. I will add back provision for bad debts 1700. Did you understand this? Provision for bad debt, or I'll write provision reversal 1700. That is 168,300 into 1 by 99. This is 25,000 minus 22. Everything's done in the third adjustment also. Only the fourth adjustment is pending. Shall I go to fourth one? On 31st March, Craft Limited's inventory include goods purchased at 1,03,500, profit 15% on cost. I told you this part. Do you remember? Cost is 100, profit is 15, selling price is 115. From inventory, I will deduct unrealized profit. That is 1,03,500 into 15 by 115. If you deduct it, you get 191,500. This 13,500 is the profit booked by holding, which is included in subsidiaries inventory. I have eliminated it from subsidiaries inventory. I should eventually decrease this from holdings profit. Come to reserves and surplus of the holding company. Here I will deduct unrealized profit of 13,500, which will give me how much as the unrealized post adjusted profit? 1,78,500. All adjustments are over. Don't have to read anything from the question. Only thing left is close that reserves, analyze the reserves, minority interest, and then notes to accounts and then consolidated balance sheet. Shall we do it? Come to reserves. How much is pre? 40,000 general. Here it is 58,700 and 74,640. Sorry, 650. And there is one more revaluation reserve. You forgot 17,500, which is minus. Can I say we get 1,55,850? Now we have to do post. Before we do that post one, help me know with this post here. 74,650 plus 1,500 plus 1,700. 77,000. Start from the beginning. General reserve post 0. P&L post is 77,850. And revaluation reserve so anyways is not there. Can I say 77,850? Identify holding company share at 80% of 1,55,850. What do we get? 1,24,680. This has to be adjusted from the cost of control. Cost of control only investments. Cost of control. Please come to cost of control. Here, shall I deduct it from book value of investment? 1,24,680. Closing will be 3,07,320. Asset is 307,320. Nominal value of investment. Asset is 3,20,000. Liability is 307,320. Liability 307,320. Asset 3,20,000. Which is more? Asset. By how much? No. Sorry. Liability. Asset. Liability 3,20,000. Asset 3,07,320. Capital reserve, which is liability, 12,680. Reserves and surplus, 12,680. Come to reserves and surplus here. I would write capital reserve 12,680. Got it? Let's go back to that reserve analysis again. Identify holdings share in post acquisition profits. 77,850 into 80%. 62,000. This 62,280 will go to reserves and surplus, consolidated balance sheet by the name revenue reserves. Come to revenue reserves here. I'll write here revenue reserves. How much? 62,280. Got it? Then come to reserves and surplus analysis only. Identify minority share. 20% of 1,55,850, 20% of 77,850. 31,170 and 15,005. Write them to minority interest. I would write here capital reserves 31,170, revenue reserves 15,570. Take total of everything and tell how much is minority interest. 1,26,740. This 1,26,740 will go to consolidated balance sheet after shareholders fund. Here, positive 126,740. All done. Only notes to accounts to be totaled and posted to balance sheet. Shall we do it? Have a look. Share capital agogide reserves and surplus. 1,20,000, 1,78,500, 12,680 and 62,280. What do we get? 3,73,460. 3,73,460 will go to balance sheet as reserves and surplus. Did everyone get this? Next, come to property, plant and equipment. Note number 4. 2 over 3 over. We already written that. Note number 4. PP. Take the total. 1,90,000 plus 1,35,000 plus 2,31,000 plus 2,09,000. 7,65,000. This 7,65,000 will be written in balance sheet PPE. Note number 4. Got it? Then what do we have? Inventory. Note number 5. Trade receivable. Note number 6. Shall I post both of them at once? Inventory. Note number 5. 1,66,000 plus 1,91,500. 3,57,500. 1,33,500 plus 1,70,000. 3,03,500. I would write 3,57,500 and 3,03,500 to balance sheet. 3,57,500 and 3,03,500. Help me with the total. 6,50,000 plus 373,460 plus 126,740 plus 2,37,000 plus 70,000. 14,57,200. Got this? Like that, similarly, take the total on the asset side. 7,65,000 plus 3,57,500 plus 3,03,500 plus 31,200. 14,57,200, and there you go, your consolidated balance sheet tallies and 14 marks in your pocket. Yeah. On